It finally happened. The red line has been crossed. For a decade, it was just sanctions. It was diplomatic pressure. It was covert operations in the shadows. But today, the United States government stopped asking nicely. Nicolas Maduro, the president of Venezuela, is in U.S. custody. But while the mainstream media is obsessing over the politics, the international law, the diplomatic fallout, they are missing the real story. The story that is flashing red and green right now on the trading terminals of Wall Street, London, and Shanghai. Look at the silver chart. In a market that was supposed to be asleep, silver just ripped upward by nearly 3.5% in a single session. That is not a normal trading day. That is a violent, vertical wake-up call. Gold is chasing it, breaking $4,400, but silver is outperforming everything. Why? Why does the arrest of a South American leader trigger a massive panic buy in a conductive metal? Because the market knows what the politicians won't admit. This isn't just an arrest. This is a declaration of economic warfare. The safe haven trade is back with a vengeance. The illusion of stability is gone. And when the world's most powerful military decapitates a sovereign government, the smart money doesn't buy dollars. It buys the only thing that has no counterparty risk. Welcome to the new volatility. Welcome to the silver shock. To understand why silver is exploding, we first have to understand the magnitude of the chaos we just stepped into. This wasn't a random event. The detention of Nicolas Maduro creates an immediate, catastrophic power vacuum in one of the most resource-rich nations on Earth. Venezuela isn't just a failed state. It is a mineral vault disguised as a country. For years, Venezuela has been a client state of the East. China has poured billions into infrastructure there. Russia has sent military advisors. They have been using Venezuela as a forward operating base. By arresting Maduro, the United States has effectively severed the head of that operation. The markets hate bad news, but they fear uncertainty. Is this a coup? Is it a restoration of democracy? Or is it the start of a civil war that will lock down the Caribbean shipping lanes? Investors looked at this chaos and realized that the global order is dead. If the rules are dead, then fiat currency, which is built on trust in those rules, becomes vulnerable. That is why the algorithms triggered the buy orders. At 9 a.m., the news broke. By 9:05 a.m., the flight to safety began. And leading that flight wasn't the U.S. Treasury bond. It was silver. So what happens tomorrow? Do not expect this to blow over. Do not expect the price of silver to stabilize. The arrest of Maduro was the stone thrown into the pond. The ripples are just hitting the shore now. The market has moved from a state of efficiency to a state of emotional distress. We are entering an era of extreme price swings. A 3.5% move in a single day might become the new normal. We could see 5%, 7%, even 10% intraday swings as the geopolitical situation deteriorates. If you are an investor, you need to understand that the spot price you see on your screen is struggling to keep up with reality. The paper market is trying to suppress the price, but the physical demand, driven by fear, is pushing it up. The question isn't, did you buy? The question is, do you have the stomach for what comes next? The game has changed. The era of cheap, stable silver is over. The era of scarcity and volatility has begun. And don't blink, because the price action we saw today is just the beginning. Let's dig into the numbers, because what silver is doing right now is historical. Usually, silver moves on industrial news, manufacturing data, solar panel demand, tech output, but today, silver is behaving purely as monetary metal. This 3.5% spike is what we call a fear premium. When geopolitical tension hits the red zone, large institutions deleverage. They sell risky tech stocks and they park capital in hard assets. But why silver specifically? Why is it moving so much more violently than gold? Because silver is the high beta version of gold. It is gold on steroids. When the fear is real, silver moves faster, harder, and with much more volatility. The arrest of Maduro signals to the world that the US dollar is being weaponized to its absolute limit. If you are a foreign nation or a foreign central bank, holding dollars suddenly feels like holding a liability, so you diversify. You buy metal. This 3.5% jump is the sound of capital fleeing the traditional banking system. The supply chain panic. Now look at the industrial side. This is where the volatility gets dangerous for the tech giants. We are already in a structural silver deficit. The world consumes more than it mines. Now throw in a massive geopolitical shock. If Venezuela falls into civil unrest, if shipping lanes in the region are contested, the cost of moving commodities skyrockets. This creates industrial panic. Companies like Apple, Tesla, and Samsung operate on just-in-time inventory. They don't have vaults of silver. When they see silver spike 3.5% on a headline like this, their procurement departments start to panic buy. They need to lock in prices now before silver hits $50 or $60. This creates a self-fulfilling prophecy. The panic creates demand. The demand drives the price up. The rising price drives more panic. We are watching the beginning of a commercial short squeeze driven by geopolitical fear. The China factor. And don't forget the silent war between the US and China. China has been hoarding gold for 18 months. Now, watch them accelerate their purchase of silver. If China believes the US is cutting off their resource colonies in South America, they will vacuum up every available ounce of physical silver on the London and Shanghai exchanges to protect their manufacturing base. They are preparing for a blockade. The Maduro arrest was the signal that the blockade has effectively begun. This massive buying pressure from the East is colliding with panic buying from the West. That is a recipe for explosive volatility.
While you were sleeping, the rules of the global financial game were rewritten. In the world of high-stakes trading, we are taught that markets are a transparent reflection of supply and demand. We are told that the best man wins based on data, logic, and timing. But last night, 41,000 traders learned a brutal, expensive lesson. The house doesn't just play the game, the house owns the board, and when the house is about to lose, it simply flips the table. Imagine the scene. It is Monday morning. You've done your homework. You saw the massive demand for silver in Asia. You saw the supply deficits. You bought in at $65, watched it climb to $80, and you were sitting on the trade of a lifetime. You were winning. But as you slept, a silent execution was carried out in the back rooms of the Chicago Mercantile Exchange. In a matter of hours, a staggering $8 drop in silver wiped out billions in retail wealth. But here is the kicker. It didn't happen because of a sudden surplus of silver. It didn't happen because the economy suddenly got better. It happened because the COMEX decided to pull the rug out from under the buyers to save the sellers. Tonight, we are investigating the silver market massacre. We're looking at the 41,000 liquidated accounts, the suspicious $88 to $74 price gap between Shanghai and New York, and the silent economic war between the US and China over the one metal that powers the future of green energy. Was this a risk management move by the exchange, or was it a desperate attempt to stop a systemic collapse of the banking giants who bet against silver? This isn't just a market update, it's a forensic look at a financial crime in progress. The forensic evidence from Monday morning, December 28th, reveals two parallel realities separated by a wall of manipulation. In the East, Shanghai silver opened at a massive premium, converting to roughly $88 per ounce, a reflection of the genuine physical hunger for metal in Asia. In the West, however, the COMEX in New York hammered the price down to $74, a 6% crash triggered not by lack of demand, but by a sudden increase in margin requirements. By raising the cost of holding a position from $22,000 to $25,000 per contract without warning, the exchange created an immediate cash crunch. Traders who couldn't find thousands of dollars in cash within hours were forcibly liquidated by their brokers. This created a waterfall of selling that wiped out 41,000 traders. This move was perfectly timed to prevent silver from crossing the $75 strike price, where 205 million ounces of silver would have been demanded for physical delivery, a demand the COMEX simply could not meet.
Now let's peel back the curtain and talk about the big picture. This isn't just about a few traders losing their shirts. This is a symptom of a much larger, much more dangerous conflict, the geopolitical war for physical assets between the declining American empire and the rising Chinese industrial machine. The arbitrage gap, West versus East. For decades, the West has controlled the price of silver through paper trading. We trade receipts for silver, promises of silver, and digital shadows of silver. But China is playing a different game. China is hungry for the physical metal. The $8 to $14 spread we saw between Shanghai and New York is a massive alarm bell. It tells us that in the East, where they actually use the metal for manufacturing, the price is significantly higher. In the West, where we use silver as a financial instrument to hedge bank balances, the price is being artificially suppressed. China is effectively vacuuming the physical silver out of Western vaults because it's so much cheaper in New York than in Shanghai. This is a massive transfer of real wealth from West to East, hidden behind a screen of volatility. Protecting the too big to fail. Who benefits when the silver price crashes? The short sellers. And who are the biggest short sellers in the world? The massive bullion banks, the very institutions that the COMEX is designed to protect. If silver had hit $90 or $100 last night, a handful of major banks would have faced losses in the tens of billions. They were staring into an abyss. By raising the margin requirements, the COMEX effectively gave these banks a get-out-of-jail-free card. They forced the retail buyers to sell, which allowed the massive short positions held by institutions to be covered at a massive discount. It's the ultimate irony of the free market. When the little guy is losing, it's called market discipline. When the big banks are losing, it's called a systemic risk, and the rules are changed mid-game to ensure the elite survive. The industrial endgame. Silver is the new oil. We are entering a net zero era, and you cannot build that era without silver. Every solar panel, every electric vehicle, every 5G tower, and every advanced weapon system needs silver. It is the most conductive metal on the planet. There is no substitute. We are currently in a multi-year supply deficit. Mines aren't producing enough, and the green revolution is devouring every ounce. What we saw last night was a paper crash hitting a physical wall. The COMEX can manipulate the margin requirements all they want. They can liquidate 41,000 or 400,000 traders, but they cannot print more silver atoms. The institutional giants, the sovereign wealth funds, and the industrial titans, they aren't selling. They are watching this crash, and they are buying. They know that every time the COMEX shakes out the retail traders, it creates a temporary fire sale for those who have the cash to take delivery of the real, physical bars. The West is sacrificing its long-term industrial security to save its short-term banking stability.
Is the silver bull dead? Hardly. What we witnessed was perhaps the most bullish signal in history. You only change the rules when you were terrified of losing the game. By hiking margins 14% overnight, the COMEX didn't stabilize a market, they exposed their own insolvency. The 41,000 liquidated traders were the casualties of a war they didn't know they were fighting. This crash proved that the COMEX is no longer a place for price discovery, but a fortress for price suppression. Silver is now a coiled spring. Every paper manipulation only increases the pressure on the physical supply. Eventually, the gap between the fake price in New York and the real price in the East will cause the entire system to snap. The question isn't how high the price will go, it's whether you will be holding physical metal when the house finally locks the doors. Was this a legitimate move or a blatant bailout for the banks? Tell us your thoughts in the comments below. Subscribe to stay ahead of the next rug pull. In a world of paper promises, the metal is the only thing that is real. Stay safe, stay liquid. We'll see you in the next one. While you were sleeping this weekend, the global silver market just suffered a massive tectonic shift. On the Western exchanges, silver is sitting at a comfortable $79.39. It looks calm, it looks stable, but that stability is a lie. Across the Pacific, in the heart of the dragon, physical silver is currently trading at over $90.25 an ounce. We aren't talking about a few cents of difference. We are talking about an $11 spread, a massive gaping hole in the fabric of global finance. In the world of professional trading, this is what we call a broken market. Behind the scenes, a silent war is being waged. On one side, the Western paper markets, the COMEX and the LBMA, are desperately trying to keep the lid on the price. On the other side, China is vacuuming up every physical ounce of silver they can get their hands on, paying massive premiums just to secure the metal. The question isn't whether silver will hit $100. The question is, why is the West pretending this isn't happening? Today, we go deep into the Asian guy AI psyops, the massive arbitrage drain, and why your paper dollar is officially entering the endgame. Let's look at the hard data. As of late December 2025, the spot price of silver in the West, the price you see on your mainstream trading apps, is hovering just under $80. But the Shanghai Gold Exchange, or SGE, and the futures numbers tell a completely different story. We are seeing $82.07, $85, and in the retail physical market in China, a staggering $90.25 per ounce. Normally, an arbitrage situation, where the price differs between two markets, might be a few cents, maybe $1 at most. Traders usually buy low in the West and sell high in the East until the prices equalize, but an $11 gap? That is a sign that the equalization mechanism is fundamentally broken. It means the West is running out of physical silver to send to the East to stop the price from soaring. Adding to the chaos is the Asian guy phenomenon. In the last few months, a network of over 36 different YouTube channels, all using highly sophisticated AI avatars, has flooded the internet with silver news. Some call it a psyop, a psychological operation. Is it a disinformation campaign designed to trigger FOMO? Or is it a distraction to keep retail investors confused while the real whales move 15-kilogram silver slabs across borders? Whether the AI channels are real or fake, the $90.25 price tag is verified by real people on the ground. This isn't a theory, it's a transaction. To understand why silver is hitting $90 in China, you have to stop looking at it as just a shiny coin. You have to see it as a strategic industrial weapon. The industrial vacuum. China has cornered the market on the green revolution. They produce nearly 80% of the world's solar panels and a massive portion of the world's EV batteries. Silver is the best conductor of electricity on the planet. It is not optional for these technologies. It is a vital necessity. While the West treats silver as a speculative commodity to be traded for paper profit, China treats it as raw fuel for their industrial empire. The $11 premium they are paying isn't expensive, it's a security premium. They would rather pay $90 now than have their billion-dollar factories go dark because they couldn't find metal at $80. The paper versus physical deathmatch. For decades, the price of silver has been suppressed by paper silver. For every 1 ounce of real, physical silver in a vault, there are hundreds of paper ounces traded on the COMEX. This allows big banks to manipulate the price by selling ghost silver they don't actually own. But China is calling the bluff. By demanding physical delivery and paying $90, they are forcing the paper dragon of the West to bleed. If you can sell silver for $90 in Shanghai, but it only costs $79 in New York, every smart trader on Earth will try to buy from New York. Eventually, the Western vaults will be empty. That is the moment the Western price teleports to $100 plus to catch up with reality. The AI psyop in information warfare. Why the 36 Asian Guy AI channels? In a financial war, information is just as important as the asset. If the powers that be want to prevent a panic buy in the West, they flood the zone with trash data. They make the silver community look like conspiracy theorists. By using AI to create a boy who cried the wolf effect, they can keep the Western retail investor from buying until it's too late. While you're questioning if the YouTuber is a robot, the Chinese institutions are smiling behind their massive silver reserves. Let's talk about the elephant in the room, the US dollar. The USD is a dying currency. It is losing value by design. Every year, the Federal Reserve prints more legal tender, diluting your savings and your hard-earned labor. Most people have forgotten what money actually is, but the U.S. Constitution hasn't. Article 1, Section 10 clearly states that no state shall make anything but gold and silver a tender in payment of debts. We are moving back to a world where real wealth is defined by what you can hold in your hand, not what a bank says you have on a screen. The $90 price in China is the price discovery of a collapsing fiat system. It is the market's way of saying the dollar is worth less than you think, and silver is worth more than we're allowed to tell you. In the silver market, we don't just talk about diamond hands, we talk about the diamond fist. Holding silver isn't just a trade, it's a statement of sovereignty. It's a way to keep your wealth outside of a system that is currently cannibalizing its own citizens through inflation. So, what is the endgame? The markets are currently digesting this $90 price point. As the global saturation of these prices continues, the pressure on Western exchanges becomes unbearable. We have entered the volatility phase. Expect wild swings. Expect more AI-generated noise. Expect experts on mainstream media to tell you that silver is a bad investment, even as it climbs toward triple digits. The takeaway is simple. The East has recognized the true value of silver. The West is still playing with paper. History shows us that physical reality always wins over paper illusions. The gap between $79 and $90 is not just an arbitrage opportunity, it's a final warning shot. The spring is coiled. The smart money has already moved. The only question left for you is, are you holding the metal or are you holding the promise? What do you think? Is the $90 silver price in China a sign of an imminent global financial reset, or is it just a temporary market glitch? Let us know in the comments. And remember, in a world of paper, be the metal.